I need you to stop and watch this video. I'm going to be talking about mortgage interest rates. It's been the talk of the town lately because of how much they've gone up. But what does that really mean to you, especially if you are thinking about buying or refinancing in today's market? My name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your home all across the country, whether you're thinking about buying your first home, buying a vacation property, or looking to build your rental real estate portfolio. We've got you covered from coast to coast. You can hit the description for links to more information on how to get your mortgage right or how to get a hold of me just in case if you need a second opinion with your home estimate. I put out content every single week, so make sure to subscribe to my channel. And if you find these videos helpful, please do me a favor, share this with your friends and family and hit that like button so that way we can continue to help educate the rest of the world when it comes to buying homes and managing your real estate portfolio. But before we hop into today's video, I wanted to give a special shout out to LaShondra. She had sent me a text and I'm going to go over her question with you because I think it's really relevant to today's market. So she had emailed us about a cash out refinance, which a lot of you have actually reached out. So for all of you that I have spoken to, thanks for taking the time to reach out, and hopefully you've been able to make the right decision with your home loan. She wanted a second opinion on your loan. She shopped around. She had found an estimate at 4.875. And she was looking again to do a cash out refinance. She's doing some renovation to her property, which is really cool. And she just wanted to make sure that everything was good to go. And after looking at the estimate that LaShondra had sent over, I told her, you know what, that was an amazing deal. And everything looked good to go on her estimate. So LaShondra, I know we spoke. Congratulations on your refinance. And don't forget to send me those pictures because I'd love to see how the renovation turns out. So if you guys are in the process of thinking about buying or even refinancing, remember, that's what I'm here for. You can shoot me an email and I'd be happy to go over that estimate with you just to make sure that everything is lining up and you're not missing anything. Now, the first thing that I want to cover in today's video about mortgage rates is the history of the rates. I think this will give you a lot of perspective as to where rates have been, where are they today. That way you don't freak out. Because I can tell you after doing this for 15 years, when rates jumped up over the last month or two, there were so many people that freaked out. Not only clients, but even real estate agents and loan officers. If they've been in the business less than 10 years, they've never seen a market like we're in right now. So really, those guys are newbies to the business. They've never seen anything above probably a 4% rate. But I want to take you guys back in time so that way you can see at several points throughout history where the rates were, just to give you some perspective on where they are today. So if we just simply Google the 30-year fixed mortgage rate, it takes us to Freddie Mac's website, and let's see how far back we go. They go back 50 years. So we can go back to 1972, and you can even see here the average interest rate back in 1972 was 7.38%, and lenders were charging 0.9 points to get that interest rate. So they were charging a buy down to get that interest rate. Now let's keep going and let's look at a few other points in time to see where we are. Let's go to the 80s because the 80s is when there was some inflation going on. As you can tell lately in the news, that's all they're talking about. Inflation is going up. It's getting worse every month. But let's look back at the 80s. Interest rates in 1982, the average was 16%. 16%. And look at this number. They were charging over 2 points to get that interest rate. So again, if you were buying a house today, and let's say your loan amount was $400,000 and you paid 2 points, you would be paying an extra $8,000 to get a 16% interest rate. How insane does that sound? I can tell you right now, if I said that to a client today, they would literally think that I was living on another planet. But guys, that's what happened back in the 80s. So let's continue to take a look and see what other time points that we had and what interest rates were looking like. I was born in 1984, so let's take a look at that year. Interest rates, the average, 13.8%, and people were paying 2.5 points to get that interest rate. How crazy is that? If you think that's crazy, I want you folks to comment below crazy and let me know what your thoughts are on these interest rates back then. Now let's go to the 90s and see what we got. So you can see interest rates are starting to get a little better. In 1990, the average interest rate was 10%. So slightly better than the 14 and 16 that we've seen. Nothing to get excited about yet. Let's take a look at 1996. The average interest rate was 7.8%, and people were paying 1.7 discount points to get that interest rate. Again, still so high compared to where we are today. And the early 2000s, here we go. Now we're in the sixes again. 2001, 6.97, 2002, 6.5%. People were still buying homes during this time. 2003, 4, and 5, we finally hit the 5% range. But you can see in 06, it bounced up to 6.4%. 2008, we were still at 6%. 2009, 5%. Finally, in 2010, 11, and 12, we see the 3 and 4% range. So you can look at that back all the way from the 1970s up until 2010. We've never seen anything cheaper than 5 or 6%. So that's why when you are looking at today's market, you cannot freak out and think that a 6% rate is the absolute worst thing that has ever happened, because every single person that has bought homes during that time frame, you can almost make a guarantee that they probably came out on the upside with that property that they've owned and probably sold. I always go back to thinking of if my grandparents would have bought real estate back in Hawaii, back in the 80s, 90s, what would that house be today? And I think for a lot of you that are thinking about relocating from California and some of these higher cost of living states, how much money would you have made, or your family would have made, if they would have bought a home back in the 80s, 90s, and early 2000s? You can look at all these opportunities regardless of what the interest rates were. There was so much upside that was made off of all these properties. So that's one thing that I really urge you guys to do some research when you are thinking about buying or refinancing on your home, because the average person is going to see the 6% rate. It's going to turn them off and they're not going to buy. And guess what? They're going to keep waiting. They're going to keep waiting, and they are going to continue to wait, which means they're only paying someone else's mortgage. And chances are, with inflation the way it's been going lately, rent payments are probably going to continue to rise as well. You can see 2013 through 2017, most of the time we were under 4%, which is kind of what everyone's used to. And now you can see where we were over the last several years. 2019, under 4%, 2020, 3.1, and 2021, 2.96. So 2.96 is not the norm. It's 1 year out of the last 50 plus years that we literally just looked at that we've ever seen that interest rate. So the thought of waiting in hopes that you're going to get a 2.5% interest rate, it happened once in the last 50 plus years. I would hate for you to not buy simply because you've been waiting on the sidelines, or you plan to wait because you think that the market is going to drop back down to the 2% interest rate again. I don't think that's going to happen, and I may be wrong, but if it does, I can guarantee you one thing. It's only going to cause a bigger buying frenzy in the market. And if you remember the last time that rates were in the 2% range, we had a frenzy of buyers that were looking to purchase homes. And more often than not, you had 20, 30, 40 plus offers. There were even articles out there that talked about homes having 100 plus offers on one property. So in my opinion, I would not want to see a 2% market again, because it's only going to squeeze out the average buyer. And I get that prices have been going up, and that is squeezing out the average buyer. I totally agree with that. However, if values were to drop and interest rates were to drop as well, to me, that's the perfect storm that will only make things worse and drive us right back to where we were. So in my opinion, I would rather avoid that as much as possible. Take the 6%. That starts to level out the market, which is honestly what we need, because we've been on an upswing for so long that the market can't sustain that. You know, seeing 15 to 20% increases in property value every single year, year after year, is just insane. We can't sustain that at all. So there has to be some leveling out, but don't let the interest rate freak you out from not buying. So now that you have a good perspective on where rates were and some key points throughout the last 50 years, it gives you some perspective on where they are today. And hopefully you can see that interest rates are not that bad. Now, what I want to show you on this next slide here is how interest rates affect your buying power. Because I think so many of you that if you've been thinking about buying and you're on the sidelines, your buying power has been eroded due to values continuing to go up, due to interest rates going up. And I wanted to show you how that is really impacting you. So let's just take an average sales price of about $500,000 and you're putting 20% down. Now, the scenario that I'm going to show you is how you can actually get back some of your buying power, because as, like I mentioned, interest rates and values going up, that has eroded some of your buying power. But there is a way through a buy down that we can get you a little more buying power back. So here's a scenario. $500,000 sales price, we're putting 20% down, a rough interest rate of 6.75%. This is if you had a 740 credit score, you're putting 20% down here in Las Vegas. Your principal and interest payment is $25.94. Again, this is just your principal and interest payment. So we're not including property taxes and homeowners insurance or even an HOA into this. This is just the bare basics of a monthly payment, just to give you a really good idea of how this program works. Now, we are seeing prices being reduced throughout the country, not only here in Las Vegas, but here's a strategy that I want you to think about. Most of you will look at a home that's sitting on the market longer than probably what it should, and your gut reaction is going to be, let's go and offer the seller less money on the home so that way we can try to get a deal. Now, in some markets, that may be great. And of course, everybody wants a deal, including myself. But when you go, and let's just say in this specific property, the seller was willing to come down on the price of the home, $40,000, you were still putting 20% down. You still got the market interest rate of 6.75%. That would get you a monthly, again, principal and interest payment of $23.86. Good deal, right? $40,000 saves you a little over $200 on your monthly payment. You get into the home. Now that you're a homeowner, you enjoy the benefits of being one. But here's how we get more buying power back, as I'm going to walk you through this next couple of slides. You go and you ask the seller for a 2% credit. Now, in some instances, you can get more than that. You can get 3%, you can get 4%. So this is where you need to talk to your loan officer about how much of a credit you can get towards your buy down. And you will also want to include your real estate agent in this conversation, because they're going to need to know how to negotiate with the seller and how to articulate this concept. Again, we're going to give the seller their list price of $500,000. However, we are now going to ask the seller for a 2% closing cost credit. Now, what the lender does at that point is they're going to use that 2% to go and buy your interest rate down. So you can see the 2% is based off our loan amount, which is $8,000. We're going to buy the interest rate down, which takes us down about 1%. So we can get you 5.75%, which is a below market rate today, because the par rate is about 6.75%. And you can argue with me and say that 5.75 is an ugly rate, because that is still a decent rate. We just went through the history of the 30-year fixed rate mortgage. Now, if you take the 2 points, buy your interest rate down, look at your principal and interest payment, $23.34 a month, which is cheaper than the price reduction. So how many of you that are still watching this video would like a lower interest rate and a cheaper monthly payment? Comment below if you want the cheaper rate and the monthly payment. Just drop in the word yes. Comment below and let me know that you would love that, because I know most of you that are watching that, this should absolutely be a 100%. Every single one of you want that. Now, why is this strategy so important to utilize? Because here's what happens. If you were buying a home and your interest rate was 6.75% and your loan officer is not showing you this strategy, because rates probably a month or two ago jumped up from 5.75 to 6.75%, you as the buyer, you lost out on about $50,000 worth of buying power. So how many of you that did not buy or decided to wait lost your buying power? Most of you probably did. And that's the frustrating part. In this case, Our buyer was looking for a home at $450,000, but when the interest rates jumped up, we lost $50,000. So how do we get that buying power back? We use the seller credits to now go get us a lower interest rate, because you can see in this last column, our principal and interest payments are the exact same. So at $449,000 at 6.75%, we have a $2,300 payment, the exact same with the rate reduction. So you can see how important the interest rates are in helping you get more buying power. So if you're on the sidelines right now, I would definitely urge you to go talk to your loan officer, ask them about a seller buy down. If they don't know what that is, send me an email. I'd be happy to give you an updated pre-approval and go over these options with you. This is going to be something that's going to get you more buying power. You're going to pay less interest on the house. You're going to get a cheaper payment, and your agent is going to have more negotiating power and helping you get your offer accepted. Now, here's another thing that I want to show you in this exact same scenario. Now, the argument may be, well, Sean, I would rather pay less on a house and negotiate the price down. And I get that. And that's what the average buyer does. That's what the average realtor will do. But you have to think about this from the seller's perspective. If your home was sitting on the market and everybody wants to beat you up on price, all you're looking at is really what you're going to net at the end of the day. And in our scenario here, like I showed you, the seller actually nets a little more money here at the bottom, and actually $32,000 more. So if you were the seller and you had 10 offers on your house, wouldn't you look for the best deal in terms of what you net at the end of the day? So this is why this tactic is a great way to help your realtor negotiate on your behalf. Now back to my point about reducing the sales price. You can see in these two options here, we're going to compare them side by side. If you were to take a $40,000 price reduction at the same 6.75% interest rate, again, this rate is simply based off of a 740 credit score on a primary residence, and we're just using the principal and interest payment to go over these numbers. If you want a specific example of what your scenario looks like, we can certainly do that. Again, just send me an email below and I'd be happy to do that for you. Comparative to the 5.75%, our payment, even though I'm paying $500,000, I'm willing to pay the $40,000 more, my principal and interest payment is still about $53 cheaper than negotiating the $40,000 off the sales price of the house. This is how you get your deal accepted. This is how you become a smarter home buyer in this type of market. So instead of letting the interest rate of the sixes turn you away, you look at taking advantage of the market. We all see this. Sellers are lowering their sales price. Sellers are willing to give you credits. So this is how you can take advantage and be a smarter buyer in today's market. So not only am I getting a cheaper monthly payment by using the rate buy down, if we look at this bottom right-hand corner here, in the next 15 years, if I were to live in this house and never refinance, I'm also paying $30,000 less interest on the property. This is another strategy, guys, that's going to help you get yourself into a better financial position, because if you can save $30,000 on interest, you can put that towards your kids' college fund. You can start saving money up to put that into the stock market investments you may want to put 30 grand into. In fact, I'm sure a lot of you watching this right now would love an extra $30,000, because guess what? Credit card debt is through the roof right now. The amount of credit card debt that we have is at an all-time high, and you are throwing away tens of thousands of dollars on credit card debt. So this is how you can restructure your entire financial picture for yourself and your family by making smarter home purchasing decisions. Now you have an asset that you own. You're building wealth, but you're doing it in a better way, so that way you can reallocate some of this money that you're wasting on interest to better yourself and your family. So this is the lowdown on interest rates right now. If you are thinking about buying or refinancing and you need a second opinion, I'm here for you. Make sure to share this video with your friend that's shopping, or even your real estate agent, because not many people are talking about this strategy right now, and this will be a strategy that will help you avoid the painful increase of interest rates, get your buying power back, and get you into a home and make you a homeowner, which is our number one goal. So thanks for watching, and I'll see you on the next video.